at 9 o'clock, so let's make a start. Good morning, everybody, and thank you for joining us on this February morning for our first of 2022 Horson's Wealth Management Investment Seminar. We've got two guest speakers today. I think it's a very timely seminar after an interesting few weeks. For those of you that might have to rush off early, we are recording this and it will be available after for you as well. I don't believe that any of us have any fire drills. We will put ourselves on mute as the various speakers are speaking. So hopefully if that happens, it won't interrupt anything. So I think, as I say, an interesting seminar, very timely. We've had an interesting few weeks, turbulence, not just the weather either. And I think with Kevin and Matthew, they're hopefully going to help you in understanding some of the times that we're going through at the moment and why we may make the decisions that we do on investment the way we do as specialists. High inflation is a huge factor. We have, impending issues, geopolitical issues to deal with. I'll keep that diplomatic. And obviously we've got situations where we've got one market performing particularly well against the world and things like that. So that's causing a lot of questions in our clients' minds, definitely. So I'm not here to steal any thunder. We're going to hand over first of all to Kevin Durant, so Managing Director at AJ Bell Investments. Thanks for joining us today, Kevin.
Pleasure
if you want to take over screen sharing, I'm just going to let people know that we'll do questions at the end. Kevin will be speaking for roughly 20-25 minutes. So please save your questions up. You can either put them in the chat box at the bottom or you're welcome to email them through if you wish to as well. Over to you, Kev. I'll put myself on mute.
Thanks very much, Nat. Good morning, everyone. Okay, so crypto. I'm sure I can't see people in the room, but I'd normally ask now, how many people have you got crypto? And depending on the age of the audience, that ranges normally between about 1 in 5 and 1 in none. So I won't do that today. However, we will do crypto. We can't talk about cryptocurrencies, though, until I introduce you to Satoshi Nakamoto. Satoshi Nakamoto is a guy that no one knows who it is. This is Satoshi Nakamoto, but it's not Satoshi Nakamoto. His name is Satoshi Nakamoto, but he's not the Satoshi Nakamoto. So by now you should be asking, who on earth is Satoshi Nakamoto? Satoshi Nakamoto is the name that was put on a scientific paper released at the back end of 2008. Remember, cash your minds back to 2008. We were going through lots of geopolitical problems and the financial markets were in turmoil and volatile on a day-to-day basis. That sounds very familiar. But Satoshi Nakamoto, whoever he or she or they are, produced a paper at the end of 2008, which talked about a world where you could have a decentralized monetary system. Now, decentralized is something we'll come back to in a moment, as is monetary systems. But this chap on your screen is not the Satoshi Nakamoto. He's a physics professor based over in Texas. And his name is Satoshi Nakamoto. And the world, ever since crypto and Bitcoin became a thing, has been searching the globe to find out who Satoshi Nakamoto is. But I guarantee you, it's not this chap. Now, to get into cryptocurrencies, mostly when I start talking about cryptocurrencies, a lot of people within a couple of minutes say, whoa, hey, hold on a minute, Kevin. This is all too a little matrix-like for me. It's starting to really kind of blow my mind here. But I want you to stop and pause for a moment and think about the world's greatest contract. It's not our friends here from The Usual Suspects. It's not Kaiser Soze. The world's greatest contract, and you all believe in this contract, is money itself. Only 4% of the money in the world actually exists. The other 96% of the money in the world exists only in your head. And thankfully, it also exists in the person sat next to you or the other 20 odd people on this call. It also exists in their head. And it's a social construct. It's a social construct which allows us to do some wonderful things. Because before the advent of money, if you wanted to trade with your nearest neighbor or someone in the next village, you needed for a couple of things to happen. You wanted to trade, you needed to have something that they wanted, and they needed to have something that you wanted. But more importantly, you needed to have both of those things, both at the same time, both in the same location. And with the advent of money, we're able to separate that transaction into two separate transactions. So now instead of having to meet someone who has exactly what you want and you have what they want at the same time in the same location, what you're now able to do is split that into two parts. You sell what your goods or services to someone for money, and then you can take that money as a store of value across other territories and over different points in time, and you can trade that money for goods and services that you would want. So that's the real advantage of money. But money is just a contract. It's a game of trust. It's effectively a religion. And if you look at it as a religion, it's the most popular religion in all of the world with 7.9 billion believers. If you add up all of the other major religions in the world, it comes to about 5 billion believers. So money is the greatest religion in the entire world. And cryptocurrency is just an extension of that. Now, lots of the believers in cryptocurrency tend to look like this chap. A lot of the initial early adopters of cryptocurrency tended to be people who would be more in the QAnon kind of category. They would be more conspiracy theorists. And the early stages of cryptocurrency was about taking money and taking power away from central banks. Because remember, go back to 2008, early in 2009, it was the first time in history of mankind where central banks have been given license to print money out of thin air in this process we call quantitative easing. Now, that money which is created out of thin air is then pumped into the economy. And at the time, it was to refloat the banking system, but that money circulates within the economy and eventually, and we're seeing this very much at the moment, eventually manifests itself, first of all, in asset price inflation, but eventually in real world shock-based inflation. And that's exactly what you're seeing at the moment. The consequences of what we did in 2008, 2009 are now manifesting themselves in the higher inflation rates that you're seeing today. And the idea behind cryptocurrencies were to take that power away from central banks so that the sanctity of your money, the sanctity of your savings was safe from those tyrannical powers of the Federal Reserve, the Bank of England, the ECB, etc. But over the past decade or so, more and more people have adopted cryptocurrencies as a medium of exchange. But not all people have adopted cryptocurrency as a medium of exchange, and it's still kind of very much in the margins. In the past year or so, as prices have gone above $20,000 per Bitcoin, and I will use Bitcoin almost exclusively when we talk about cryptocurrencies as a shorthand for all cryptocurrencies. But when Bitcoin went above $20,000, it piqued the interest of general investors. So much so that we had lots and lots of people that were asking about our views on cryptocurrencies. And that's what prompted me to put this presentation together. So let's get into cryptocurrencies. But before we get there, it's really important that you understand the banking system that you use on a minute by minute, day by day basis in the real world right now. There we have our two groups of people there who want to do a transaction. And what happens in the current banking system is those people will have access to the banking system via a node, which we call a licensed bank. So whether you're a Monzo customer, a NatWest customer, an Investec customer even, they are nodes into the banking system, and you have a registered account with those licensed banks. Now, what happens in the current banking system is an agreed ledger of every single transaction that's ever taken place in the currency of record that we're looking at, and we're looking at sterling here, is all agreed on a centralized basis amongst all of the nodes, all of the banks within the system. And all of those records then tell you every transaction that's ever taken place. But if, of course, if you know every transaction, you also know the running balance of every single person within the system, and you can tot up how much money they own or how much money that they owe as a result of that agreed ledger. Now, wouldn't it be nice if you could sneak into the banking system, scrub out some of the numbers on the ledger pertaining to your account, and add a couple of notes? That would be really nice, and it would also be quite fraudulent, and it would undermine the whole confidence associated with the banking system. So in order to make sure that the banks are also acting sensibly in this contract, we then on top of that put a central bank, and the central bank acts as essentially the police force to make sure that all of the banks, all of the nodes in this system are behaving appropriately. But what if the central bank is dodgy? Well, in this case, what we do is we put a big flag on top of it, and we say it's a central bank which is backed by the government, and therefore it has societal guarantees on the central bank, and they oversee the entire licensed banking system, which gives the people in society the confidence that all of the transactions on all of the agreed ledgers are all legitimate, they're all kosher, and as a result, we can get on with our lives. That's what the current banking system looks like. What does that look like in a crypto world? Well, you'll see that as we flick between one slide and the next, not an awful lot happened. You still had your people who wanted to undertake a transaction, but your node, your access point to the crypto monetary system is not through not through a bank, a registered bank, it's through a registered node, which in the early days of cryptocurrency would have been literally your laptop or your desktop at home. Any computer, can be registered as a node on the crypto chain. And what I've just used a phrase there with the crypto chain or the blockchain. What happens in the crypto world is instead of having a single, really, really, really long list of all the transactions that have ever taken place, what happens is every 10 minutes, all of the transactions that have taken place in the past 10 minutes go onto what's called a block. So I've got a chain of blocks on my screen here, goes onto the latest block. And instead of a centralized central bank overseeing all of this, what we have instead of that kind of societal guarantee is we have a crypto guarantee. And that's where Satoshi Nakamoto comes in. So whether he, she, or they were or are, they created a crypto algorithm which ensured that once all of the transactions had been verified by one of the nodes within the system, it would automatically verify on every single node within the system. And so instead of having a centralized central ledger, you now got a decentralized ledger so that all of the transactions are registered on every single computer within the entire system, but all of those computers agree what the transactions are, and all of those transactions then add up to be the ledger of all transactions that have ever taken place, in this case in Bitcoin, throughout the entire system. So you might question, well, why on earth would anyone do this? And why would all of these people devote their computers and their computing power in order to make this system work? That's where Bitcoins come in. Bitcoins are the reward for the computer that solves the little puzzle, and I'll come on to the puzzle in a moment, that solve the puzzle that verifies the latest set of transactions and then transmits that message to the entire network, and therefore all of those transactions are agreed. So Bitcoin is the reward system for maintaining the decentralized ledger. Now, I talked about an algorithm there. You may have heard that old kind of proverb, if you left enough monkeys in a room with enough typewriters, eventually they would knock out the works of Shakespeare. It's essentially the same principle that's taking place on the blockchain every 10 minutes. So every 10 minutes, the monkeys of the world are knocking out Hamlet and Macbeth and Midsummer's Night's Dream. Every single 10 minutes. And the algorithm that they use in order to do that is called SHA-256. And that's a hash algorithm with 256 bits of information. And what that means is it's really, really complicated. The best way to think about it is, if I give you a plate of mince, you would have to tell me the name of the cow, and you would have to put the cow back together again. So theoretically possible, but practically impossible. It's a transaction that takes place really easily in one direction, converting a cow into a plate of mince, but really difficultly in the other direction, turning a plate of mince back into a cow. But it's theoretically possible, and if you throw enough computing power at it, it is possible. And indeed, it takes place every 10 minutes on the blockchain. So what is Bitcoin and what's its role within the monetary society? I've listed down here a number of things that you would want money to do. Money is essentially what money does, and money has been a whole bunch of things over time, ranging from tulip bulbs to shells to stones, a whole bunch of things. But the main two kind of real solid concepts of money in the modern day would be the dollar and there would be gold. But if we look at these kind of, these two forms of money, and you look at what you'd expect money to do, you see down there all the 7 things that you would want money to do. Actually, even the dollar is not a great candidate. So it's not limited supply. We've demonstrated that in the financial crisis through quantitative easing. And actually around the globe since 2009, there's been $14 trillion worth of money created out of thin air. And as a consequence of that, it's not a great store of value over the long term. So it is a store of value on a day-to-day basis. A dollar in your pocket today is worth a dollar tomorrow, but a dollar on your pocket today will be worth around 60 to 70 cents in around 10 to 15 years' time. So it's not a great store of value over the long term. You can see via my emoji system here what I think of gold and there. But if we go onto Bitcoin, we go to cryptocurrencies, actually on the first 5 measures, Bitcoin wins hands down versus the other forms of money. However, it's not accepted widely in society. And I would question you, or question yourself, would I be willing to take Bitcoin as a form of payment for a good or service that I provide to the rest of society? And in particular, when it comes to store of value, is it a store of value even on a minute by minute, never mind the day-to-day or over the long-term basis? So I've given this presentation a number of times over the course of 2022 alone. And over the course of 2022, we started the year around $70,000 per Bitcoin. It's been as low as $30,000 per Bitcoin. And as I sit here today, although it could have changed in the past couple of minutes whilst I've been on the screen, it was around $38,000 per Bitcoin. And you might want to go and have a quick look at where it is now, but I guarantee you it's not $38,000. So it's not a store of value, and therefore I would contest that it doesn't perform the single most important role in terms of money, which is acceptability and the short-term store of value. So I would not consider it to be a cryptocurrency at all. AJ Bell, when we talk about Bitcoin and the like, we don't talk about cryptocurrencies, we talk about crypto assets or crypto commodities. And crypto commodities is really where I want to take you now, because we've got next to Bitcoin there, we've got a block of gold. If you understand the gold market and you understand gold as an investment, you already understand Bitcoin. Bitcoin is essentially just digital gold. Gold has no value to society whatsoever. Through its chemical formulation, through it, it doesn't tarnish, it doesn't diminish, it's divisible, and you can shave it off, etc. It's really become kind of over periods of millennia, it became the de facto standard for people's highest form of money. But it has no societal value whatsoever. If you look at the gold mining industry, it's effectively a bunch of people digging something out of the ground in South Africa in order to bury it under the ground in Switzerland. It has no value in society whatsoever, other than a few applications in electronics and a few applications in dentistry. But gold until 1974 was the highest form of money across society, including within the central bank system. But in 1974, our man Tricky Dicky here popped up on the US news and announced that they were taking the dollar off the gold standard. Now, any historians of money will know that that was a seminal date in the history of money, because prior to that, all currencies, including the pound, have been convertible into gold as the highest form of money. You could turn up at the central bank with your wad of pounds, and you could legitimately ask for them to convert those wad of pounds into gold. As a consequence of World War I and World War II, kind of the central banks didn't have enough money in the gold vaults to offer that facility. And so we came off the gold standard. And what happened instead is we converted to the Bretton Woods agreements, which instead of all money being convertible into gold, all money was convertible into dollars, and then all dollars were convertible into gold. And then Tricky Dicky came along in 74 and blew the Bretton Woods agreement apart. And as a consequence of that, there was a mad scramble for gold. So you can see there in 1974, gold traded at under $200 per ounce. You had a massive spike in the 1980s as people scrambled for gold in order to rebalance their portfolios. But then gold didn't really do anything for practically 30 years. And it was only as a consequence of the last financial crisis in 2008 and the European debt crisis in 2011 That's what pushed gold to the heights that you see. And then, of course, you come along to COVID around 2020, you see a spike in gold. So gold tends to move sharply during times of crisis. But over the long term, if you'd have bought gold in 1980 and you just kept pace with inflation, you see actually all it's done is kept pace with inflation. So it's preserved your real purchasing power, but it's not giving you an increase in your purchasing power over the subsequent 42 years. So yes, it's been an inflation hedge over 42 years, but as you can see, for large swathes of that 42 years, it actually underperformed even inflation. Whereas if you look at equities as an example, you would struggle. In fact, you cannot find a 10-year period where equities underperform inflation. And so if you are trying to protect your portfolio from inflation, we don't even think that gold is necessarily a great thing to be holding within portfolios. But what's the appropriate price of gold? And this is where commodities come in. So when you're pricing any asset, it needs to have a cash flow. But gold doesn't have a cash flow. It's a bit like a piece of art. The only cash flow you'll get from gold is the cash you get when you eventually come to sell it. And therefore, it doesn't really constitute, in our opinion, a genuine investment. It's a speculative asset class. But it is possible to value gold. And the way we would value gold is to acknowledge that A, it's a commodity, and B, that it's widely traded. So for every piece of gold that you have, and let's face it, all of you will have some gold probably about your person right now, probably in your ears, possibly on your fingers. Slightly younger audience might have it through their nose or even the nipples. But gold will be about your person. So you do have tradable gold. All of that gold is exactly the same as any piece of gold that's just been dug out of the ground in South Africa, as we've sat on this call today. And therefore, the price of your gold on your ring or around your ears is worth exactly the same as the piece of gold that's just been mined in South Africa. Now, the price of mining a piece of gold in South Africa is currently just over $1,000 per ounce. So the marginal cost of production for gold is just over $1,000 per ounce, but it currently trades around $1,800 per ounce. So in our view, gold is around 40% overvalued, because eventually, given the price where we are, more and more gold will be put into circulation, and those two prices will converge as the price of production increases and the price of gold decreases. And we think the fair value on a gold is around $1,400 per ounce. Now, why have I given you that as an example? Because it allows us to value cryptocurrencies. So earlier on, I talked about the computer on your laptop or your desktop at home, which could be used to mine cryptocurrencies. Well, yes, you could have done that in 2008 and 2009 in the early days of cryptocurrencies, but this is now a huge, large-scale industrial process. And what we're looking at here is a crypto mining facility. And every one of those wires and boxes that you can see on your screen there is a supercomputer. These are the monkeys of the day typing out Shakespeare on typewriters. So these are your monkeys. They are furiously guessing the answer to the problem, what's the name of the cow? And when they get the name of the cow, they're rewarded with a Bitcoin, and the whole facility goes on. But of course, with the price of a Bitcoin is $70,000 per Bitcoin, and every single block of Bitcoin that gets mined gives you access to 6.25 Bitcoins. You can see that every time you guess the right answer, every time you enter into that lottery, you're rewarded with around $500,000 as a reward. So you can see how very quickly people will be keen to play this lottery game. But this is what the lottery game looks like. And you see all of those wires streaming off into the distance there? That's all connected to the national grid. So if you want to look at this, it's effectively a massive Xbox. And imagine kind of in your children or your grandchildren's room, that huge Xbox sucking power out of your electricity system, and you know what your electricity bills are going to be. So it is possible to work out the marginal cost of producing a Bitcoin. And we calculate that by looking at electricity prices from around the world. So what we've done here, or what the guys at Elite Fixtures have done here, is they've gone around the world and they've looked at the electricity cost of mining a Bitcoin. Now, most Bitcoins currently in the world are manufactured or mined. It used to be in China and the United States. Interestingly, then it went to Kyrgyzstan and the United States. But let's use China and the United States as kind of the benchmarks here. And we look at United States would cost you about $5,000 to mine a Bitcoin. You look at China, it's around $3,000 to mine per Bitcoin. Let's take the average of those. The marginal cost of production of a Bitcoin is $4,000. And as I said to you before, Bitcoins are currently trading at $38,000. So we applied the same rationale that we did to our gold in order to value gold. We would argue that Bitcoin is about 80 to even 90% overvalued at this moment in time. You shouldn't have it in your portfolio, and I recommend that if you've got any of it in your portfolios or knocking about on some of your Coinbase facilities, now is probably a good time to say, I've had a bit of fun here, it's time to get out. Now, in the last gold rush, and that's what we're facing here, in the last gold rush, and these are the guys in the Klondike, the people who made the most money out of the last gold rush in the Klondike were not the people, not these young guys, and these are the crypto bros of the day, not the young guys who went out to the Klondike and got rolled up their sleeves and, you know, swung away with their picks and their shovels, etc. Those were not the people who made the money out of the last gold rush. The people who made the money in the last gold rush were not these chaps here. They're the guys who sold you the picks, the shovels, the pans, and the sieves. And here's just a range of companies that sell the modern day equivalent of picks, shovels, pans, and sieves. Now, the nice thing is, if you're running a global equity portfolio, I practically guarantee you these 4 companies are already in your portfolio. So by all means, let the crypto boys and girls have their fun. Let them go off to the Klondike. Let them spend time in their Reddit chat boards and enjoy the ride. But we, as more rational investors, have access to this trend, are able to make some money out of this by selling them the picks, the shovels, the pans, and the sieves. And that's already in your portfolio. Hopefully that's been useful, and I'll hand you back now to Nat.
Thank you very much, Kevin. Incredibly useful, and never fails to let me down, that presentation, I must admit. I'm going to now share. So again, if you want to ask questions, please feel free to either email them through or use the chat facility at the bottom. All questions are going to come across anonymously, only to the panelists. So we will just see the questions and I'll pick those up at the end of Matthew's presentation. Kev, if you want to just pop yourself on mute. Matt, I'm going to do a quick screen share and then you'll be ready to go on your, and if you just let me know when you'd like to do the next screen, I will move you on each time. So welcome to Matthew.
Thank you, Natasha. That's great. That was really interesting listening to Kev there. And I have to say, I think that's one of the best explanations of crypto I've heard in the last few years. So well done, Kev, without shadow of a doubt. Following that, I'm here to talk about slightly more mundane things, such as what does constitute a sound investment. And I think, in a fairly basic way, the way that I've chosen to do that is just to talk about risk, about the kinds of investments that you can invest in a portfolio and the risks that they bring. And what does an investment manager like Investec, who I work for, or AJ Bell, who Kev works for, what do they do to try and build a portfolio and manage risk in a lot of ways? I've got a couple of specific examples. Some of it is slightly more theoretical, but hopefully it's all relatively straightforward. What I don't know is, and if you could flick on to the next slide, please, Natasha, is just how well you can see things, because I'm not sure my slides are quite as clear as Kev's, but please do shout if you can't. The first slide is on risk. What we're looking at here is something called the Vix Index, and it's an index that represents volatility fundamentally in world markets. And what we've got here is a sort of a 10-year time period going back to 2012. And you can see from this, so that as a measure of volatility, that for the first sort of 6-7 years or so, volatility really was relatively steady. we then get to March 2020 and we have this enormous spike in volatility. And for those of you on the seminar that were invested in March 2020, when the pandemic hit, you will remember probably just how that felt and the effect it had on your investments over a very short period of time. On average, I would say somebody who had a medium risk portfolio spread across lots of asset classes, but maybe with 2/3 in equities, you probably saw 20% of your portfolio diminish in the space of about 7 or 8 working days. So that was an enormous spike in volatility. And what we can see as we've come through the pandemic is that that volatility level has come down, and we got to the middle of 21, things were feeling better from a coronavirus point of view. The global economy looked like it was stoking up again, lockdowns were being eased, company profits were nowhere near as badly hit as people thought they would be. So it comes down and then it starts to spike up again as we get towards the end of 2021, and now we're in 22 and it's shot off again. And yesterday it shot up again as well with the news around Russia. If we can just flick on to the next slide, please, Natasha. As an investment manager, what we look at on your behalf is risk versus return. If you can see this slide, this is one of my all-time favorite slides. I think it makes it very, very easy to understand and clear how you might start to build a portfolio. Now, what we've got here in essence are 4 boxes, if you can see them. The top left one has the word unfortunate written in it. The bottom left one, if you can see it, it's marred a little bit by the figures, has the word defensive written in it. The top right one has the word adventurous written in it. And the bottom right one has idealist written in it. The scale at the left is volatility, so that's the amount by which your assets move. The scale across the bottom is your annual return above inflation. We've then got lots of different coloured blobs that represent the investable asset classes as we see them. Crypto isn't on there because it's not realistically been around long enough, but it will find its way on there at some point. Everybody wants to be in the bottom right-hand box with the greatest level of return for the least amount of risk. Perfectly understandable. And what we can see from this is that there is only actually one asset class that does that. And that's infrastructure funds. Now, they've realistically only been investable since about 2005, so we've not had the longest time period. And what you can see here is that in the other boxes, let's move to the top left, bearing in mind we've just been talking about commodities. Top left, the unfortunate box, commodities, if you've held them for a long period of time, have given you one of the lowest returns, but with the highest level of volatility and risk. So going back to what Kev was saying, you know, if you bought gold 40 years ago and held it, you've just kept up with inflation and you've had no cash flow, no income, no dividends, no interest. So commodities can be a valuable asset class, but we view them as something you probably want to rent rather than own. So you'd want to own it at a certain period of time, but probably not something that you tuck away in your portfolio forever. Let's go to the top right box, adventurous, and here we find equities. So equities offer generally the highest level of returns, but a slightly higher level of risk than infrastructure, for example, but a lower level of risk than commodities. So you get rewarded for taking the risk by investing in equities over the longer term. And the data for the equities here goes back nearly 100 years. In the bottom left box, the defensive box, probably what you'd expect to see in there. Cash gives you very little return, but very little volatility. Government bonds give you slightly more, but more volatility. And you might think, why? Why are government bonds more volatile than cash? Because banks can fail, governments don't. Well, government bonds are priced and those prices move. So unless you buy a bond and you're going to absolutely hold it till the day it redeems, you have some risk. We then have corporate bonds, which are issued by companies instead of governments. They give you a slightly higher level of return again, but again, slightly more risk. Then we have property, which everybody will be familiar with. Reasonable returns, not too much risk. And then hedge funds. Now, if we had a hedge fund manager here, he'd tell you that his red blob should be on the right in the idealist box. But by the time you've knocked all of the charges that they charge you off, he disappears back into the defensive box. But they can offer a sensible part of a portfolio. Why am I showing you all of this? I'm showing you all of this because as an investment manager, when Natasha comes to me and says, I have a client here, we need to have a look at this, I've assessed their level of risk. We then go in and pick a bundle of these assets with a view that if you can manage them in a certain way, you can hopefully get yourself into the corner edge of the idealist box. But you've got a spread of assets. You're not relying on infrastructure to purely do it for you because the track record there isn't long enough. And that's what we try and do. And that, for me, if you can manage that over a longer period of time, represents a sound investment, the name of this seminar. Next slide, please, Natasha. This is something that's broadly telling you the same thing, so I'm not really going to dwell on this too much, but it's just interesting to have it in the slides, and I don't know whether the slides are going to be made available to people, but obviously this is being recorded. So this again is about lowest risk, highest risk, and you can see right over in the right hand side, pink I think it is, alternative investments. They encompass a massive range of risk, low risk investments all the way up to high risk, because sitting in that bucket is commodities, they're high risk, is infrastructure, that's much lower risk, and hedge funds sit somewhere in between. So a great big long swathe there. Whereas the next one in purple is equities, and there you can see, they are not low risk on their own, but they're not the highest risk you can invest in. So again, it's about blending things together, diversifying and blending assets to produce a portfolio that represents a sound investment. Next slide, please, Natasha. Natasha mentioned at the beginning that, clearly we are at the moment, we are in a volatile period. This is a broad range of asset classes and how they've performed from the start of 2022 up till last Friday. I think we ran these numbers. Now, interestingly, what we can see here is that commodities have given you a very good return during this period, with equities and government bonds giving you the worst returns. Other than Russia and Ukraine, which clearly is having an impact on volatility, and I'm not here to talk about politics, etc., but it is having an impact. If we put that on one side, the biggest issue for investors at the moment is monetary policy, monetary and fiscal policy, is inflation and interest rates, basically. So we all know inflation has risen sharply in the last few months. We know that central banks have started raising interest rates and that the signals are that that's going to continue. And so what we see here is the sensitivity to that is that government bonds, for example, have fallen sharply. UK government bonds have fallen sharply because interest rates are going to go up, bond prices fall, so the yield on those bonds goes up as interest rates do. The effect on equities has been that if you think as any equity investment has been either, let's say, a growth orientated equity or a value orientated equity, the last 5-10 years you have been massively rewarded, and unfortunately I've not got a slide on this, but I'll tell you this. You've been massively rewarded for owning growth. And for example, Investec is an investment house. We have had a long-term bias to quality growth companies. What we've seen in the course of the last few months, and especially as we've rolled into 2022, as the prospect of interest rates going up and inflation is higher and likely to go higher before it comes down, I think that's fair to say, lots of these very good quality growth companies where you've normally got long-term visibility of earnings have been affected by the fact that interest rates are going up. It affects the valuation of those companies when analysts are looking at them, and we're starting to see some reaction to that. And investors have been not en masse, but there's been enough shifting out of growth companies into other assets, one of them being more value orientated companies. And what do I mean by that? That might be a company that doesn't have the same visibility of earnings. It might be an airline. You know, I wouldn't want to be in the airline industry, but you know, trying to judge where your earnings might be in the next few years as an airline will be very difficult. But equally, cyclical value companies like miners, so commodities, again, they're intrinsically linked with commodities, have certainly picked up well. Oil has done very, very well in the last few months. So this chart is basically showing us that on the whole, equities are underperforming, have fallen as we've come into 2022. One of the really interesting points though is, and it comes back to this growth versus value, and I'm not sure how you can see it on here, but the third bar in from the right is the S&P 500, which is a broad measure of the US stock market. And you can see that so far this year, that's fallen about 7 or 8%. We go further across to the left, one of the bars that has risen is the Ftse 100. Now, can we compare the Ftse 100 to the S&P 500? We can't really, because Apple, for example, constitutes a greater value than the entire Ftse 100 put together. And Apple is only one constituent company in the S&P 500. There are 499 others. But the Ftse 100 does have a number of value-orientated cyclical stocks like miners, like oil companies, and with rising interest rates, banks. So I think possibly one of the questions that has come in is that the Ftse's gone up, but my pension scheme's gone down in 2022. If all you'd been invested in was the Ftse, your pension scheme would have gone up. Most people probably have more in overseas equities than the UK. That's the way the market's orientated from a market cap point of view. And where people like us, certainly at Investec, we've wanted to invest more in overseas over the last few years. We're in a short-term period where that is reversing. Overseas equities have given much stronger returns over the last 5 years compared to the UK. There's a small reversal going on at the moment. Next slide, please, Natasha. Thought I'd pick a couple of investments to talk about. And these sort of exemplify risk in some senses. The red line and the red blob is an equity-based, a global equity-based investment trust called Monks. Some of you might be familiar with it. The bottom blue, I think it is, although it looks a bit green on my screen, blob is the BBGI Infrastructure Fund, which is a lower risk, that sits in the lower risk portion of your portfolio. And these are the returns that you've had of these two investments over the last 10 years. And what we can see is that Monks has given you a return of 86% over that period. I'm sure anybody who's owned it would think that's great. You know, that's a fantastic return. I'm really happy with that. But you have to have accepted a much higher level of volatility to own Monks than, for example, owning the infrastructure fund, which has given you a return of nearly 50%. That's not bad. That's not bad. And a good proportion of that return for the infrastructure fund has come to you by way of dividends. So if you're an income investor, that is a great fund to own. You get a 5% dividend yield and it chalks capital return of about 2 or 3% on top of that. The reason I'm showing you these two things is it emphasizes a different level of returns you can get from one asset class, equities, but still very solid returns from a lower risk asset class, infrastructure. And the skill is to blend these things together, as I was saying earlier, to make sure that you're in the right parts at the right time. And look how Monk's Investment Trust, as we've come into 2022, has fallen. It's very much a growth-orientated fund. Going back to what I've just said about growth versus value, Monk's has been hit. It is full of quality companies. That falls much further. That is a mega buying opportunity, we would think, as part of this growth and value battle goes on. And it is likely to go on for a little bit longer, probably for the rest of this year. Next slide, please, Natasha. Probably won't spend too much on this because basically it's showing where are these funds invested. If we look on the right, Monks is a big chunk in technology, their growth stocks, a big chunk in consumer discretionary stocks, their growth stocks, healthcare growth stocks. On the left, very different investment is the infrastructure fund. They own physical social infrastructure projects like prisons, bridges, hospitals, and a lot of these things are in effect rented back to governments in the UK, various parts of the world on index-linked rents. So you have some inflation protection here in an infrastructure fund. So we are using those at the moment to help protect against inflation. Next slide, please, Natasha. What does a medium risk balanced portfolio broadly look like, bearing in mind everything I've just said? The thing to focus on here is the bottom right hand side, where we've got some lines on a chart. Realistically, they are bands in which, if you're a medium risk investor, certainly with Investec anyway, these are the corridors in which you will see the asset classes appear in your portfolio. So at any point in time, over a medium term, you might expect to have somewhere between 50 and 75% in equities, between sort of 10 and 35% in fixed interest, up to sort of 15% possibly in commercial property, up to 20% in alternatives, and at any point, a strategic amount of cash. It's this blend that tries to get you into that bottom right-hand idealistic box, rather than, God forbid, being in the top left-hand, as it used to be called, we don't call it that anymore, hopeless box. We call it unfortunate now. Used to be called the hopeless box, but we thought that was a bit unfair. You don't want to find yourself in there. We're trying to get you into the bottom right. Next slide, please, Natasha. This is just to emphasize performance of a diversified, blended, sound investment portfolio. And if we just go to the chart on the right with the numbers on it, the one in the middle, let's go back, goes back 14 years, October 2008. You've had an annual return of 7.7% for being in one of these medium risk portfolios. Crypto might have given you, Kev might tell us, over that time period, 100,000% if you're in at the beginning, but crikey, it'll have been one hell of a ride. This is a sound investment. This is a long-term investment. It does have volatility. You don't put it in if you want it all back in 6 months, but if you want to invest solidly for the future, this kind of blended portfolio should realistically do it for you. Next slide, please, Natasha. A few bits and bobs about why working with your advisor at HWM, they are the people who assess you, assess your level of risk, build your overall plan, and they then come and talk to people like me, people like Kev. How do we do this? How can we build a portfolio for this client? And it's about working really closely in partnership with Horsons to get the best for you at the bottom of at the end of the day. And that's it. Thank you very much for your time. Thanks, Natasha.
Thanks, Matt. Very informative. And I don't think I think whilst either of you didn't see each other's presentations, I feel like they've gone together very well indeed. So thank you very much for that. I'm just going to pop up the any question slide. So by all means, get in touch. I have actually got a few questions already, so I'm going to hit it off straight away. One that came in pretty early, and again, I'd like you both to take a chance, or somebody take a chance on answering the question. That's absolutely fine. This is something that has been a massive hot topic. So the Ftse is sat at a high of 7,500, as we know. Yet, and this person has put pension funds are falling, but I think we can generalize that as most investment funds are falling. So Matt, you did touch on this marginally in your presentation.
I'm happy to just answer it slightly more specifically, and then let Kev add
please
anything.
Do. Yeah, please do.
I would imagine whoever else has asked that question has probably got a diversified portfolio with lots of different assets in it, but they will almost certainly have a greater exposure to overseas equities than they have in the UK. So by way of an example with us, for example, if you're currently in that medium risk balanced bucket that we've been talking about, you will probably have about 60% of your portfolio in equities. That 60% though is probably 40% in overseas equities and 20% in the UK. Virtually all overseas equities markets, so Europe, US, have fallen so far this year, but the Ftse's gone up. But it's not gone up enough in that mix to give you an overall positive return. And I think the other important part is the bit I was talking about growth versus value as well. Whichever index we're talking about, value at the moment is winning out over growth. So if anybody is interested in the US stock market, there is the Dow Jones, which we've probably all heard of, but that only represents the 30 largest companies. And then the S&P 500, which is the 500 largest companies. Not a lot of value holdings in the US. US investors are all about growth. They're not bothered about dividends. They just want growth. We personally have had a bias towards the US. So of that 60% in equities, 20% in the UK, 40% overseas. Of that, you've probably got nearly half of that 40% in the US, which have done you really well for a long period of time if you've been in the market that long. But right now it hurts. And people like me, people like Investec, and I'm sure AJ Bell, we are all sitting here scratching our heads trying to figure out the best thing to do about this. We're well aware that there are some imbalances in what people are seeing in the UK versus what their portfolios are doing. Personally, if I was going to invest for the much longer term, and that's what most people are doing, quality growth companies, I think, will reward you. And there's going to be the odd year where they don't, but I think quality growth will truly reward you looking forward. Kev.
Matt, you've covered it. Nothing to add.
Good man.
Excellent. I think another thing from, certainly from Horseman's Wealth Management perspective, we always talk to clients about the need for funds, and, unless you need all of your money out at a volatile period, don't worry, the chances of you requiring all of it today, if there is a slight hit, are probably minuscule, because with good planning, us as your advisor will know when you need money, and that's where that dialogue comes in, and working together really comes to the forefront. I have another question. So I'm just going to read this. So are there any investments you've recently added to or increased allocation to in portfolios, and what are the reasons for this? Are there any investments you've removed / sold or decreased, and why? So again, and then I do have another one specifically for you, Kev, so either of you can answer this.
Well, do you want me to just have a go at this, and then if there's
go for it, Matt.
I'm sure Kev will have to. Yeah, so there might be clients on the call here who are invested with Investec. Mm-hmm. What I'm about to say is broad. Doesn't absolutely mean it's definitely happened in everybody's portfolio, because there are, people's circumstances are different. In respect of this growth versus value, yes, we have recently broadly sold some growth in the UK equity space for those that were holding direct UK equities, to try and trap in a slightly more value focused approach. Slightly. Still very much emphasis on growth, but maybe just slightly less, and then slightly more on value. We've done that by selling one or two individual equities, UK listed equities, which are very growth orientated, and actually switch that into a value orientated UK equity fund. Picking value companies that you want to own is a difficult business. It really is. So we've employed a fund to do that. That's one thing. One of the other things we've certainly looked at is exposure to fixed interest. We know if interest rates are going to go up, that government bonds are going to go down. So, corporate bonds realistically should offer you, they still might go down, but they'll offer you a better return, and probably a better income return. And certainly trying to find some level of inflation linking, because we know that inflation hasn't peaked. And I think I think we're in the camp that we genuinely think inflation will start to come down towards the end of this year. But are we going to go back to the last 15 years of having had inflation at probably 1.5%? No, we're not. It's probably going to come down and settle at something like 2.5%, 3%. So we do have to learn to live with that, I think. So some inflation protection, infrastructure is very good investment in that scenario. Index-linked bonds to a certain extent, although I won't go into the ins and outs of those. It can be a little bit counterintuitive. So yeah, we've been doing things, things like that. At the end of the day, equities, providing inflation doesn't stay at, it's probably going to hit 6 or 7% here. I think we should warn ourselves about that.
Yeah.
It's already hitting 8%, going to hit 8% in the US more than likely, could go higher. Providing inflation comes back down and settles at, say, the 2.5 to 3, equities can survive quite nicely in that scenario. Kev.
Yes, and so in our portfolios, we manage them to risk widgets. So kind of if we put risk into a portfolio, we take it off somewhere else. So more recently, kind of we lowered our exposure to corporate bonds. I just don't think you're being paid enough premium over government bonds for the risk that you face. So we lowered our exposure to corporate bonds, but the two kind of sectors that were flashing green for us over the past 12 months were around 12 months ago, energy was flashing green for us. So we increased our exposure to equity. And then just around Christmas, we increased our exposure to banks and financials as an early cycle kind of play. So, banks in a rising interest rate environment, that's when they make, significant gains on the spread between the rate of return they give you on your deposits and the rates that they charge their customers in terms of loans. So that net interest margin, I just know, tends to expand at the early point in the cycle. And I think you'll see, some nice stuff coming out of banks and Lloyd's results tomorrow. And wouldn't be surprised if they start giving capital back to shareholders as well.
Here's hoping, Kev. I've got another one then, specifically regarding crypto for you.
Okay.
So I'll read this out. At some point, will you regard utility coins,
okay,
inverted commas, such as XRP and XLM, etc., as Spades and Pics, worthy of holding in a portfolio?
No is the short answer, but that requires a bit of explanation. So kind of, I understand you have the utilities, the ripples, etc. Where yes, they provide a function as well as just kind of a medium of exchange. So understand the situation there. Our view on where crypto goes over the next 5 years or so is, kind of expression I've used a lot is you can't regulate cyberspace, but you can patrol the perimeter. And you are seeing some of that already. So there's been some kind of some of the more criminal aspects, and I'm not going to get into this. Let's beat crypto up and say that it's used solely by money launderers, because let's face it. Have a look at some of the stuff coming out of Credit Suisse. The whole banking system is used for money laundering purposes in some respects. So that's not my angle on this. My angle on this is, so when you're a central bank and when you're able to print money in the way that we have in the past 10 years or so, that conveys on you a significant amount of power to react to situations as we've seen in terms of COVID and financial crisis. But that power has a name, the name of that is called seigniorage, and having access to seigniorage is almost like a nuclear weapon. So I don't imagine the Defense Department would gladly give up nuclear weapons and let common citizens have access to nuclear weapons. So they would look to regulate that. And I think what you'll see is, like I say, you can't regulate crypto space itself, but you can patrol the perimeter. And eventually, unless you're going to spend your life in the metaverse and all of your life will be spent there, and all of your transactions take place in the metaverse, okay, by all means, get yourself involved in any cryptocurrency that you like. But once you step out into the real world, that transition from meta into real world, I think that's where the authorities will patrol the perimeter. And I think ultimately where we see things going is banks will look to introduce central bank digital currencies, which will be utility coins, as the questioners suggested there, they will perform a function rather than just a medium of exchange, but they'll be central bank controlled rather than just left to kind of the crypto bros. So that's where we see things going. That said, what happened in Canada in the last couple of days hasn't helped that, because there is back to our friend with the pointy hat on, there is a conspiracy theory that the central banks could abuse that power and kind of basically cut off access to the financial services infrastructure, not dissimilar to what Justin Trudeau has been trying to do with the Ottawa truck drivers. So Justin Trudeau has not done central bank digital currencies a great favour at all, nor has he given democracy a favour, but hopefully democracy will win out and he'll be voted out next time.
Thank you, Kev. Last question then, unless there's any more to come through, but I think we will call it a day there. I'm just conscious of time. We said it would be an hour. Again, either of you could answer this. So what is your view on the prospects of UK residential buy-to-let as an investment over the next 3 to 5 years? Are you better off as a private investor, a private individual buying into a fund?
Happy to go first on that one.
Go for it, Kev.
Property is probably one of the most complex investment asset classes you could ever possibly wish to come across, and yet everyone in the UK is genuinely an expert on it, and I don't mean that in any facetious way. The level of knowledge about UK property amongst UK investors is phenomenal when you consider how complex it is as an asset class. The way we look at property is the same way as we look at corporate bonds. You will have some prime properties, and those prime properties will be properties where there is such demand that you can increase your rents, at least in line with inflation, possibly above the rate of inflation. Absolutely own them in your portfolios. In an inflationary environment, you want to hold real assets like that within your portfolio. There's secondary properties where, okay, you've got a tenant in there at the moment, but such is the dynamics of the market, you're probably unable to increase your rents and certainly can't increase them higher than inflation, in which case now you've got a nominal asset in an inflationary world. That's not a great asset. And then you've got tertiary properties, which is you might not even have a tenant in that property and you might struggle to get a tenant into that property. You absolutely don't want that in your portfolio. So that's kind of our view on how we look at properties in the UK.
That's really good. Anything to add, Matt?
Yeah, I'm not sure. Your question wasn't about residential property, was it? Residential buy-to-let?
No, it was. It does say, yeah, UK residential buy-to-let as an investment over the next 3 to 5 years.
Yeah, I think it's pretty hard to do through funds. There are very few funds that do that. So realistically, you do have to go out and do it yourself on the whole. I maybe look at it one way, and that's how you're going to pay for it. If you're going to mortgage it, be prepared to think of what's about to happen to interest rates, clearly, because some people, there are still, I think, 2 million mortgages in this country that aren't fixed. So some people are going to get a really nasty shock as we go through 2022 and into 2023. And by that I mean, if you were a first-time buyer 3 years ago and you managed to get an interest rate of 1.2%. But you've not fixed it, you could easily see your payments go up 300% in the next 12 to 18 months. So I think there's going to be some horror stories and some shocks in the UK property market. Maybe not so much this time around in the US. I mean, the US has a different way of financing residential property, so it shouldn't be as volatile. So my point would be, how are you going to fund it? And if you are going to fund it, definitely fix it. But as an investable way through funds, we've never done it at Investec. We'll only look at commercial, and in that space we have a great preference for industrial, logistics, warehousing and healthcare, all of those areas where we can see them being quite hot for a while.
And I think greater liquidity as well, isn't it, through a fund? If you do need money back out of a property, a single property you own, you're going to have to go up and either mortgage it, sell it. Can't carve a brick out of the wall.
Yeah, that's absolutely true. Although, at times liquidity can be pretty poor in property funds as well, but that's probably another conversation. Yeah.
Okay, so I'm conscious of time. I will wrap this up for today. I wish to thank all our attendees for your time this morning. I hope it's been a really informative session. thank you to our two specialists, Kevin and Matthew. Much appreciated for giving up your morning. Well, a little bit of your morning at least. I've not taken it all. And yeah, we'll see you hopefully in the future for more seminars throughout 2022. Thanks a lot.
Look forward to it. Thanks, Nat.
Bye.